chapter 24, balance of payments. When there is balance of payments, it means there is interconnectedness of economies. It means you have deal with other countries. That would make you to talk about balance of payments. So that means there's globalization. So before we go into balance of payments, here I said the interconnectedness of economies. This applies to the process of globalization. So there's globalization, the movement of capital, the movement of people, the movement of assets from one country to another, or across the world. That is globalization. So globalization has made me to be here today teaching you. That's globalization. So because there's globalization, countries can deal with other countries. Then there will be value for whatever we do. So if I have exported to other countries, it will come in a value. If I've imported from other countries too, it has to come with a figure. So this is what we mean by balance of payment record. So there are 4 key ways in which this process of globalization has been taking place. So globalization has occurred based on the following reasons. 1, the proportion of output of an individual nation economy that is traded internationally is growing. So these days, we have started doing transaction. Countries have started doing transaction with other countries. So the transaction has increased. So that means globalization is occurring. 2, there is ever increasing ownership of physical and financial assets, such as companies or shares on loan in one country by economic actors in another country. So that means these days you could choose to have your business abroad. Then you could choose to be an investor abroad. You could choose to be a shareholder abroad. You could choose to set up your business there, which means some certain income will come back to your country, which is part of the primary income. So you get your interest or you get your dividends from abroad. This is globalization. 3, individuals are moving in increasing numbers from one country to another, migration. So I've moved in here from Nigeria, I've moved in here. This is globalization. Some people have emigrated, some Libyans have emigrated to other countries too. That's globalization. Is it clear? Now we go to, because of these things, there comes balance of payment account. So what is balance of payment account? It is the record of all financial deals over a period of time between economic agents of one country and all other countries. So there's balance of payment record because there's balance of trade, because there's transaction. So transaction has occurred between countries, which has to be recorded in terms of monetary value. That is what we mean by a balance of payment account. Is it clear? So for the balance of payment account, we have the current account, the capital and financial account. So our focus now is on the current account. So for the current account, here it says flows of money into the country are given a positive sign. Flows of money out of the country are a negative sign. So money that comes into your country, in the balance of payment account, it will be of a positive sign. And if money is going out, it will be a negative sign. That means for your exports, positive sign. For your imports, negative sign. I think it's clear. So the components of the current account. So for what is the current account? The current account has 4 components, which is the trade in goods, the trade in service, the primary income, and the secondary income. This makes up the current account in the balance of payments record, okay? So we go to the trade in goods. When I talk about trade in goods, we're talking about visible goods, things that we can see, we can touch, we can touch. So for trade in goods, we have visible export, visible imports. Do you get what I'm talking about here? So there's your balance of trade, visible. There's your balance of trade, invisible. So the balance of trade visible means balance of trade in goods. So in trade in goods, we have visible goods, visible import, visible import, visible exports. So what are visible exports? Visible exports are goods bought by foreigners or goods sold by our country to foreign customers. Do you understand what visible export is now?
Yes.
Then we have visible imports. Goods that are bought by domestic customers from foreign businesses. Do you understand the difference between visible import and visible export here? Visible exports are goods sold to foreign customers. Visible imports are goods bought by domestic customers or domestic residents. Is it clear?
Yes.
Then we have our balance. Okay, then we have what we call balance of trade in goods. So what is the balance of trade in goods? This means the difference between our visible export and visible import. So the difference between your visible export and visible import will give you your balance of trade in goods. Is it clear?
Yes.
Then we have trade in services. So when I talk about trade in services, we have invisible services, invisible export, visible exports, invisible export, invisible imports. So what are invisible exports? Invisible exports are services bought by foreigners or foreign customers, or services sold to foreign customers. Then we have invisible imports. These are services that are bought by domestic customers, or services sold by foreign businesses to domestic customers. Is it clear?
Yes.
Then we have what we call balance of trade in service, which is what? The difference between your invisible export in service and invisible import in service. I think you understand what we're talking about. Great. Then we go to the primary income. So for the primary income, this is the income that results from the loan of factors of production abroad, which I told you earlier that your investment abroad, they are primary income because transaction has taken place. Trade has been exchanged. There is interaction. So whatever money that comes to you is a correspondent to the transaction you have done with them. So if you are a shareholder in a foreign company abroad, then you will be paid dividends. The dividend will be sent to your country. It's part of the primary income of the country. Do you understand what primary income is here? Yes. So your dividends, interest, profits made by the factors of production abroad are your primary income. Is it clear? Yes. Then we have the secondary income. For the secondary income, these are income between countries without corresponding transaction or trade. So you give money, it could be voluntarily given. Oh, Libya gave Tunisia $100 million. This is a secondary income for Tunisia.
Okay.
It will be of a positive sign for Tunisia and a negative sign for Libya. But no corresponding transaction was done. It was just a money that was given. Is it clear? Do you understand primary income and secondary income here?
Yes.
So for your current account in the balance of payment, it comprises the visible, the trade in goods, the trade in service, the primary income, and the secondary income. The trade in goods is the visible goods import, invisible goods export. Trade in service, invisible exports, invisible imports. Then primary incomes, the money that comes into your country based on the factors of production you have abroad, like investment, like company share, like being a shareholder in foreign companies. Then you have your secondary income, which is transactions, which is exchange money transfer from one country to another without any corresponding trade transaction. Is it clear?
Yeah.
Do you have any question about it?
No.
Okay. Then we have the distinction between the balance of payments, deficit, and surplus on the current account. There's current account surplus when all your credits are greater than your debits in your current account. When the credits in your current account are greater than the debits in your current account, then there's a current account surplus. On the other hand, if your credits are less than your debits, that's a current account deficit. That means your debit is more than your credit. That's a current account deficit. Is it clear? Mm-hmm. Then we have what we call government deficit and balance of payment deficits. Most of the time, people make mistake about current account deficit. They feel it's because government has been borrowing money. No, not only government borrows money. Billions of individuals, they do transaction with foreign companies. They import from foreign companies on credit, and they even borrow to pay those imports. So these, because individuals can also borrow from abroad, buy from abroad without payment, it increases the imports in goods in the country or the imports in services in the country, which brings up about current account deficit. So it's not about government borrowing alone. That is what we're trying to say here. So it is not only government that can borrow from abroad. Individuals can also borrow from abroad, which they do. Businessmen, they do. And in the course of doing this, excess of it might lead to a current account deficit for the country. Sometimes government try to correct them, and most of the time government will just leave it for the free market to solve the problem. Do you understand what government deficit is here now? Yeah. So not all current account deficits are caused by government borrowing. It could be by individuals. That is what the point is. Any question about it? Is it clear? Yes. Now you have the activity.